Americans are being crushed by credit card debt right now. Credit card delinquencies have now doubled. Have you heard the latest data on credit card delinquencies in the United States? If you know anything about Americans and credit card debt, I'm sure you can guess it is not looking good right now. Now, according to new data from the Federal Reserve Bank of New York, credit card delinquencies reached 8.5% in the fourth quarter of 2023. That's before Christmas. That's up from 5.87% in 2022 and 4.1% in 2021. So essentially, within the span of 2 years, credit card delinquencies have more than doubled. All stages of credit card delinquencies, including 30, 60, 90 days, saw a sharp rise at the end of the year. This is out of control, guys. We're hearing again and again from the current administration that the U.S. economy is healthy, yet so many Americans are relying on credit cards, carrying expensive debt that they are ultimately unable to pay back. The total amount of credit card debt in the United States has surpassed $1.13 trillion, which on its own is troubling, but the state of delinquencies is skyrocketing, showing true financial ruin for people. The amount of debt is one thing, but then they can't pay the bill. Now they're financially ruined. Imagine trying to get a loan, get a car, rent a house. They can't do it. We're seeing this unfolding right now across the United States. Delinquency rates also rose in auto loans, mortgages. It's clear there's a widespread state of financial stress that is plaguing America right now. Delinquencies especially can have a harmful impact on the lives of Americans. A delinquency on your credit report will obviously impact your ability to obtain future loans. I know it did for me. I had a 500-something credit score at one point because of a few bills I couldn't pay when I was broke and I was in my mid-20s, and I had a lot of debt. It was crushing. And I had to walk around with that albatross around my neck of that really low credit score and those delinquencies. I couldn't get a new credit card. I had trouble even getting an apartment to rent. Even landlords and insurance companies are going to gauge your trustworthiness based on what's on your credit report. And a delinquency is one of the biggest red flags that you can have. The implications can range from being denied a place to live to needing a co-signer now to get a loan. And oftentimes you're going to have to pay higher prices for everything. Oh, you're delinquent? We're going to have to charge you more. And this type of negative ding on your credit report will follow you around for 7 years. So there are a lot of factors at play when it comes down to these glaring problems with your credit card debt. Many economists point to interest rates, inflation, and increased costs of living. We also know that many consumers are relying on credit cards to supplement their income, and a large portion of the population is simply overspending. And all of those factors are certainly part of the equation. And it's a truly perfect storm right now. We know the inflation is hurting Americans' wallets. The cost of nearly everything surged during the pandemic and after. And it was really, of course, after the pandemic when the Biden administration decided it would be a great time to sanction Russia. And then, of course, you have economies like Germany going into a recession, the United States depleting its strategic oil reserves, the cost of everything skyrocketing, and it hasn't come back down. And to make matters worse, credit card APRs are only increasing. Let's take a look at this right now. This is from the Federal Reserve. A few years ago in 2021, interest rates on credit cards averaged about 16%. By the end of 2023, they'd risen over 22%. People are being swallowed alive by interest alone. And as much as the lenders and banks contribute to these problems, they too are seeing massive economic instability. In the first quarter of 2024, JP Morgan Chase reported credit card costs of $2 billion in charge-offs alone. Jamie Dimon, the CEO, wrote in a report, "Looking ahead, we remain alert to the number of significant uncertain forces. First, the global landscape is unsettling. Terrible wars, violence continuing to cause suffering. Geopolitical tensions are growing. Second, there seems to be a large number of persistent inflationary pressures, which may likely continue. And finally, we've never truly experienced the full effect of quantitative tightening on this scale." What is he saying? Yeah, all of the money printing from the Fed, we haven't really experienced it yet. We're seeing this rise in inflation. That's just the tip of the iceberg. That's just one bank. What about Wells Fargo, Citigroup, other major lenders also reporting huge credit card losses last year? So with that being said, we can assume that most credit card holders are not going to see relief anytime soon from their lenders. Rate cuts are likely not coming until later this year. Credit card rates are always much higher than the Fed's benchmark rates anyway. And so are mortgage rates typically as well. But aside from these major contributing factors, there's something that's widely overlooked. A lot of problems that we're seeing in this country are surrounding debt are caused in part by a widespread lack of financial education. Most Americans don't understand how credit cards work, how the APR works. They don't understand minimum payments. They don't understand interest rates and how they work in tandem to keep you in a debt trap that's permanent. A 2023 survey by Clever found that 28% of credit card users don't even know what their credit card's interest rates are. And when we look at the data, it's younger, lower income households that are struggling the most with this debt. And as I've talked about time and time again, these credit card companies are out there targeting people. They're on college campuses. They're at the cash register at Michael's, which boasts the worst interest rate in the country, by the way. So if you're going there to buy some crafts, don't sign up for that stuff. You're going to get burned. It is a scam. I remember signing up for something at Macy's when I was like broken in my 20s. That thing had a huge interest rate on it, and I lost the bill one month. I didn't know where. It didn't show up in my mailbox, or maybe it did. I lost it, so I missed the payment. That thing haunted me for years. Don't sign up for those things. And financial education is really the only cure for this. We have no control over interest rates, inflation, the price of goods. The only thing borrowers can do is empower themselves, become armed with the information that will allow them to get out of this vicious cycle of mounting credit card debt. And also, stop buying liabilities. Start buying performing assets. That's what we teach you here on this channel. We'll get back to the video in a second, but look, your money is not safe. You can see all the time that stocks can crash, bonds lose value. Anything that you can't physically put your hands on increases your risk right now. Hey everyone, I'm Clayton Morris, longtime real estate investor and founder of Morris Invest. And my favorite tangible asset is real estate. It consistently outperforms other asset classes. And I believe it's the #1 way to build and protect your wealth. Now, while there are several ways you can invest in real estate, most of which I've tried myself, the build to rent model offers the most benefits. More specifically, single family buy and hold rentals. Here's why. Much lower risk than trying to flip a house. You have more control and higher returns than REITs. If you're investing in the stock market, it's way less work than wholesaling properties if you're into wholesaling. Many fewer repairs and headaches than trying to rehab a property. My company, Morris Invest, along with the help from our partner at Sedera Wealth, helps you invest in build-to-rent properties as easily as investing in stocks. That's because we buy and build in bulk, and then we pass on our savings to you. And when you purchase a property through us, you get discounted pricing on properties at or below market value. Seller incentives like mortgage buy-down rates and credits right now usually lowers your rate by about 1%. And we know with higher interest rates right now, you definitely want that, right? And you get free ongoing customer service for the life of your investment. Get personal phone numbers and email addresses of our team. And build-to-rent properties are in prime growth markets. We're talking 18% internal rate of return. 18%. Amazing tax benefits. And you get a free cost segregation report, helping find strategies that increase tax write-offs. You get principal reduction as your tenant pays down your mortgage. And you get steadily growing appreciation and equity gains. Plus, positive cash flow. We won't sell you a property if the math doesn't add up. If you want to know more, just click the link in the description box and it'll take you to our website where you can book a free call with our team. There's zero pressure, no obligation. Look, I understand we won't be a good fit for everybody, and that's totally okay. Some of you might want to be DIY, you want to do it yourself. That's great. Either way, you're going to walk away from our phone call with some valuable new insights and an idea of what questions you might want to ask and some actionable steps that you can take to move forward in your financial journey. You can always find an excuse to not invest, but the sooner that you start a smart investment like build-to-rent real estate in a strong market, the sooner you'll be enjoying pure cash flow. So click the link below and I hope to see you on our schedule. So if you're one of the millions of Americans who are struggling with credit card debt, I want you to watch this next video right now where I walk you through specific action steps that you can take to start tackling consumer debt today. Watch this video now.